Pankaj Murarka is with us now, CEO and CIO at Renaissance Investment Managers. Pankaj, great to have you with us here. Thanks very much for your time, as always. I was right before opening, so two things, right? One, consumption, maybe mass consumption as a sector, perhaps as a theme, starts to pick up a little bit. I mean, that idea at least is entering the minds, maybe because that space is done badly and there are some triggers. The government seems to be pushing for consumption to revive. Would you agree and go along with that kind of thesis? And what would you do if you did?
Morning, Prashant. We've been talking about this. We've spoken in the past as well. I firmly believe in a recovery in the consumption. We've said that, we are coming out of 2 years of consumption slowdown in the economy. And more importantly, I think there are now enough triggers to expect a meaningful revival in consumption as we get into the festival season, because you see, starting from start of this year, in the budget, the government did a tax cuts of about 1 lakh crores, which is about 30 basis points of fiscal stimulus. And now on top of this, we have the GST cuts, which will add another about 30 odd basis points of fiscal stimulus. So cumulatively, there's been a 60 basis point of fiscal stimulus. And RBI has done about 100 basis points of rate cuts, which effectively translates into a monetary stimulus of 40 basis points in terms of savings on EMIs on home loans, car loans, credit card loans, and everything else. So in a matter of about 6 or 8 months, we've seen about 1% of GDP as fiscal and monetary stimulus that's been injected into the economy. I think that's very significant in the context, and that should lead to a recovery in consumption starting from the second half of this year as we get into festival season. And I would think we would see a recovery in both staples as well as discretionary. So consumers is one of our preferred sectors where we have significant overweight position at this point of time.
Okay, we'll come to that. Just a broader call, Pankaj, on the markets. This 27th August tariff deadline is looming in front of us, Wednesday. Will this trigger a sharp market reaction, or do you think it's in the price now?
Rima, I don't think so. Markets will respond to this 27th August deadline in a knee-jerk fashion, because markets are taking a slightly more medium-term view on the whole tariff subject. And as we all know, the tobacco trade has worked pretty well over the last 6 or 8 months. So eventually, I think President Trump will chicken out, and probably somewhere, down the road, there is a bilateral trade deal between India and US. It's important for India to not just, be submissive and probably negotiate. So all of us know that these are more negotiating tactics rather than meant to be longer term tariffs. So I think markets will overlook the 27th August deadline and look at the issue from a more medium-term perspective. And I think from a medium-term perspective, the effective tariffs on India will be much lower.
That's the hope, Pankaj. Let's hope you're right. But I recall that that big call you said that after a few years, you're turning constructive on staples. So that seems to be, in the limelight right now. So hopefully that call goes well for you. But the other comment that you had given me the last time around was on defense stocks. You're still not taking money off the table. Maybe you're in early. What's the view right now? Because, we're getting those big orders that are coming in now. The Prime Minister is clearly focused on it. And the globe on the whole seems to be quite focused on defense spend. How do you approach this space?
Well, the ordering momentum or probably the growth momentum will sustain for defense companies, Nigel. I think at least there is fair degree of visibility for the next few years. But having said that, as I've been saying, that stocks are extremely expensive, meaning all those defense companies are trading at 50, 60 times 12 months forward earnings. And essentially, when you do a reverse DCF on these companies from a longer term perspective, they're pricing in pretty high, 25-30% profit growth over the next 10 years. Well, I'm unsure whether these companies can deliver that kind of earnings growth over a very long period of time. So I think one should be careful in terms of owning or nibbling into these stocks at these levels.
But if you have it, you'll hold it?
Yeah, I think probably people owning it can probably hold it, but new buyers should be slightly careful because valuations are extremely rich, and buying companies or businesses at such extreme rich valuations for a longer term investor generally does not yield into healthy returns over the long term.
This overweight call on consumption, what percentage of your portfolio would broadly be in consumption, and which would be the subsectors that you have the confidence to put money in right now?
Well, Rima, consumption, from our point of view, we have a significant overweight in consumption. So across portfolios, we have about almost 14-15% of our portfolio into consumer space. And we're playing it through a mix of both, as I said, staples and discretionary. So we're essentially looking for companies which can grow above industry growth, and companies which are making significant investments to grow their business at a higher rate or probably take market share. So some of the companies that we own across staples includes likes of Godrej Consumer, and within the discretionary space, we own companies like Jubilant Foods and companies on the durable side, which essentially includes companies like Whirlpool and Crompton and Havels as well.
Yeah. No, point taken. Pankaj, what else? What else is on your radar? Are there lots of new listings, right? And some of them are interesting lines of businesses, Bunch has done well. Anything you've sort of latched on to? One argument I hear nowadays, maybe I don't know, is the relative market cap argument. I've heard it for a range of businesses that, okay, this is what market cap is only $1.5, $2 billion. Look at the industry leader. It's at 20 billion. Not even industry leader. It's at 20 billion, 25. I'm sure you've heard it as well. What do you make of that? And of course, in terms of new listings, anything, in terms of ideas that you'd want to share?
Well, these are kind of classical arguments which we get to hear in a mature bull market, which is where India is, where obviously, we need to realize, Prashant, or concede that we are in the 6th year of this bull market, and India is the most expensive equity market in the world. So markets are priced to perfection, and obviously there is no apparent value on the table. And in this kind of a matured bull market, probably that's the only relative argument one could make. I don't think so. These kind of arguments hold much water for a value investor from a longer term perspective. Traditionally, Prashant, we've stayed away from IPOs because generally we like to spend a lot of time with the investee companies before we put our money to work. And because these companies we've not had a good amount of history with these companies, and probably our understanding of these businesses is not so great because these are newly listed companies, we tend to stay away from these kind of companies. Some of the other pockets of markets which I like is one I've always said this for some time. I'm still continue to remain extremely constructive on the internet space. I think India's internet ecosystem is on a high growth phase probably over the next decade. So companies within that space are still growing at 20-25%. And I think they can sustain that growth rate for the next decade or so. More importantly, these companies are very agile and they're making very, very quick pivots in their business to change business models and make changes in the business as they are required to. And many of these companies are now either profitable or are getting very close to being profitable in that sense. I think while we already have one company, Eternal or Zomato, which is part of the index, my views over the next 5-7 years, probably internet companies will contribute at least 10% of the Nifty index, because many of these companies are consolidating their respective industry segment at a very rapid pace. And most of these companies are operating in a space now which has very limited competition, just 2 or 3 or 4 players kind of a thing. So effectively, the runway for these companies in terms of enlarging the profit pool is very long drawn. So that's one space which continues to excite us. Across our portfolios now, internet is almost 10, while index weights is low, but in our portfolios, we have almost double-digit exposure to internet companies, be it food tech or fintech or some of the consumer tech companies. So that is one space which really excites me, and despite a cyclical slowdown in the economy, as I said, these companies will continue to grow at a reasonably high rate.
Food tech, right? The Swiggies and the Zomatos, etc. You think they can become much larger in terms of size over a period of time? Hospitals, Pankaj, any thoughts here? Again, it's a space which is completely re-rated last couple of years.
Yeah, I think the view there remains positive because there are enough drivers for that. All of us know in India, healthcare spends are, very low, and they will only keep increasing. Hospital demand for beds just keeps increasing, and India now is also becoming a very favored destination for even patients from across the world coming to India for the low cost medical delivery that India can deliver. So I think, and that's again one space which is immune to economic cycles to a significant extent. So at this point of time, probably some of these are better plays in that sense because you're immune to economic cycles, be it interest rates or inflation, and they're still growing and probably will have a long-term growth visibility over the next 5 to 10 years.